Welcome to the Financial Foundations podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolfe.
Welcome back to the Financial Foundations podcast, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe, certified financial planner.
We hope that you all had a great Thanksgiving holiday. Today, we're going to be jumping into some of the market insights and a recap for the month of November. Be sure to listen to the entire episode because we're going to be going over such topics as Federal Reserve rates, 10-year Treasury yields, inflation, retail sales, and more. Alex, let's just dive right in. As for the Federal Reserve policies, how do the recent decisions of the Fed, especially the unanimous agreement to hold interest rate hikes, impact investment strategies?
Yeah, so I don't think it was all that surprising that they decided to hold rates. While it is big news, not that surprising. So when you think about interest rates moving forward and how it affects your portfolio, we're starting to see short-term yields decrease and long-term yields remain steady. So where before we had kind of a flat yield curve where the rates on a 3-year Treasury were almost the same as like a 5-year. They were just a hair over 5%. So we're now starting to see short-term rates decrease. So back to a normal yield curve. So with our investment approach, when we have clients who we put in short-term CDs and Treasuries and they're maturing, we're starting to go longer term in duration. So we're buying 3, 4, 5-year fixed income instruments so we can take advantage of those higher interest rates. And what it's indicating, and I think we'll talk about it a little bit further on in this episode, is they may be done raising interest rates based on what the yield curve is showing us.
Okay, and with the Federal Reserve aiming to bring inflation down to 2%, how might their evaluation of monetary policies influence market dynamics? And what potential adjustments should investors consider?
So there's no doubt that the Fed's been very hawkish, meaning they've been consistent with their approach to raising interest rates to get inflation back down to a reasonable number. And as you mentioned in the intro, we're averaging 3.2%, which is way better than 7.8% that we saw earlier this year. While not down to 2% yet, it's on its way. So it is my belief that they're going to hold rates higher for longer, but probably won't have to raise rates further. So until that 2% comes, they'll probably keep rates pretty level. I saw an article earlier, I think it was last week, that some economists think that there may be up to a 1% drop in rates in 2024. And I think that's awfully optimistic. It would only happen likely case if we saw, not like a huge recession, but if we started seeing back-to-back quarters of negative GDP growth, which is the measurement of a recession, then they may start to lower interest rates. But I think that they'll be pretty stable for a while. And when you think about what that means for your investments, we hope it doesn't mean stagflation, which is where inflation kind of remains high for a while. So we definitely want to see that 3.2% continue to drop. But I think that there's opportunity for finding those bond yields, as I mentioned before, that might be further in duration instead of short term. And I think it may impact money markets. So people have been, and including us with our management approach, keeping a little bit more in those higher yielding money markets. But if the yields start to drop on those, you might see some deploying of cash into various investment types. And I think an area that is attractive is these dividend paying value companies. They have not experienced the same level of growth in 2023 that the big tech companies have, like your Meta, Apple, Microsoft. Those companies have done considerably well in 2023 and have really held up the S&P 500 and the indices and providing almost all the returns and just the big mega cap stocks.
So how do you explain the U.S. stock market strength despite slowing consumer spending and the the 10-year Treasuries retreat from its October peak?
I think it says a lot about the market and the financial strength of a lot of these companies. And it's not just like it's been one particular sector, although there are certain sectors that have done considerably better than others in 2023. But I think that given the environment of inflation easing, corporate profits have continued to remain pretty strong. We saw a lot of corporate earnings in earnings calls in this month, and some of them adjusted their forecast, but a lot of them hit their targets and outperformed during the last quarter, which was good to see. So we did have one negative quarter of GDP growth in 2023, but I don't know if we're going to get a second. So that means that maybe we didn't see a recession in 2023, but could it come in 2024? So that's what we're going to be monitoring is as we get through the end of the year into next year, what did Q4's numbers look like? And I think they're going to be pretty good, but I'm not as optimistic about next year. But the initial data we're seeing from holiday sales after Black Friday or during Black Friday seem to be pretty strong, which kind of goes against what some of the retailers were projecting going into the week. So that'll be interesting to see.
Okay, let's go ahead and shift into unemployment and wage data. So given the rise in unemployment and the lower than expected payroll numbers, how should investors interpret these employment indicators in the context of their portfolio?
I think that it certainly bodes well for bringing inflation down and was an indicator for the Fed that consumers and households are not going to be in the same financial situation that they were coming out of COVID when we saw household debt at all-time lows. People were spending money like crazy. They had built up savings. But now that we've seen savings being depleted, people are spending more on credit and unemployment numbers are up. I think it is going to signal inflation will likely continue to come down because people likely won't be spending at the same rate that they were previously if they're between jobs or didn't get that pay bump going into 2024. And we've seen that so far in November when we had a slew of retailers release earnings and they lowered their guidance, meaning that they think that the holiday sales may not be as strong and that going into next year, they were really pulling back on some of their sales forecasts. So I think that indicates consumers are going to be careful with what they're spending and pulling back on their spending.
And how does that impact the way that you think about investing in this environment?
I think it's going to provide some challenges in not just like saying don't buy those retail stocks if sales are going to be going down, but I think the opportunity is in the value companies like Walmart, Dollar General. These companies have done okay this year, but certainly haven't outperformed expectations. And you think of like the Targets of the world, those could be areas of an investment opportunity in those value companies versus your luxury retailers or growth stocks. So I think we're going to be looking to add to value and pull out some growth because I think there's going to be some weakening in the economy and we could see another quarter of negative GDP growth, although it's not predicted for Q4, which we're in the middle of right now. In addition to, part of the value play could be the utility providers. Think of your NextEra Energy, Xcel Energy. These have not done well in 2023 and are pretty beat up, but they're really attractive right now given their current valuations. And if you think about if we are going to be entering into a recession, people still pay their utilities and need electricity. So those particular stocks will do well.
And given the interconnectedness of economies, how do you see global economic trends influencing investment decisions in this current scenario?
You pose an interesting question, and It's not a simple answer, and I'll tell you why. First, we're seeing inflation still being a problem in Europe. So they're going through what we went through earlier this year. So they are monitoring interest rates with their government oversight committees, or basically their version of the Fed, to help get inflation under control. There's also quite a few political campaigns and elections going on right now globally addressing these same concerns that we are. So what we're going through and what the global economy is going through, there's definitely a lot of overlap and similarities, specifically on those hot button topics like unemployment, immigration, and inflation. So those are kind of the hot topics in a lot of countries. So the same things that we're discussing here in the States. So with other countries having to raise interest rates to combat inflation, just like we saw a large investment in U.S. debt because they could take advantage of higher interest rates on U.S. debt, we could see people investing in high quality debt in European countries or in the UK. So there could be some inflow in fixed income investments globally. But what's different are the two wars going on between Russia and Ukraine and Israel and Palestine. That's the tricky part. So I don't think there's a lot of attractiveness to the global economy in Europe and even in parts of Asia. I think China's going through some interesting things economically speaking. So from an international stock standpoint, I don't know if international is the right play right now, but fixed income wise could be.
Now let's shift into the real estate news for the month. With the recent significant drop in mortgage rates, how do you see this impacting the housing market, and what opportunities or challenges does it present for potential home buyers and existing homeowners?
It's been an interesting year in real estate, specifically single family housing or multifamily like condos. With the drop in mortgage rates, obviously is good to see on a couple levels, but it presents challenges as you stated in the question or you're asking me. First is obviously the demand. You're seeing more applications for mortgages, which is encouraging. At least here in Florida where we are, we've seen more supply and homes sitting longer, which is not a surprise. Real estate housing costs are still high here, even in the high interest rate environment. But that means that they're going to be looking for a very specific or motivated buyer. I don't think there's a lot of people looking for a home that aren't being intentional. Like they're looking for a home, or if you're looking for a home, like you're pretty set and you know the interest rate environment we're in, there's not a lot of people like kicking the tires. Like you're not just out going to open houses for fun like you might in a lower interest rate environment, even despite the run up in housing since the pandemic. The challenge is as interest rates are declining and likely to continue to decline, you're going to get a more demand. And what happens to the already high prices in the housing market? Will it cause that to go up because there's more demand? Or does it kind of level out? You know, do you have the same amount of demand as supply? So maybe you don't see that run up in housing prices even as more buyers come into the market due to the attractiveness of mortgage rates. I mean, they're still very high compared to 2 and 3 years ago. They're like double.
So yeah, I know that even though interest rates have come down, they're still not at our last 10-year average. So now in terms of economic risk management, how might the potential risks of over-tightening by the Fed influence your advice to clients in terms of investment and mortgage-related decisions?
So one of the challenges that they've faced this entire time is the possibility of over-tightening with the monetary policy of raising rates and issuing bonds is putting us into a recession. And I think they've navigated this pretty well so far. All credit to them. But where do they go from here? And how do they continue to bring inflation down without throwing us into recession, which is something I stated earlier, discussed earlier in this episode. as far as leaving rates higher for longer instead of having to raise rates. So if we continue to see loans and mortgages and the interest rates come down, even if it's just ever so slightly, I think people will see that as a positive, and they won't have to continue to tighten, but kind of leave that the rates a little bit higher for longer to see how things shake out. Now, as we get through the end of the year and we see how consumers spend during the holidays and, did they have to dip far into credit, and we'll see, retail sales data, that will show signs of how the economy's doing. And then they'll be able to kind of maybe adjust their strategy going into next year once we know a little bit more after the holidays and retail sales and job numbers. And we've seen unemployment tick up, which we talked about. But when you think about how all this is affecting your portfolio, I think it continues to show that we maintain, a diversified strategy. And now that we've seen a decent year in the market, almost everything is positive across the board in the major indices, is a good time to reevaluate your portfolio and see if you are over allocated into growth or stocks and under allocated in bonds or small cap. There's definitely areas of opportunity, but maintaining your diversified approach is going to work out well for you. Now is not a time to run to safety if you think there's a recession on the horizon. There's still sectors that will perform well even in possible recessionary environment, which we could be in.
All right, now I know that everyone loves the IRS and taxes. So can you tell us what changes that they made this year? They make some changes every year, and I know there's some tax bracket changes that you can discuss now.
So given the inflationary numbers of this year, the IRS has made some adjustments for the standard deduction and also adjustments to the highest tax bracket. So the standard deduction for a married couple filing jointly is now $29,200. And for a single filer, $14,600, which is pretty significant if you think about the standard deduction and how big it's gotten, honestly. So it's becoming increasingly hard for your average household or worker to be able to itemize a tax return because the standard deductions are pretty high. So you have to find and be sort of creative or have some big medical issues or awfully charitable to be able to take advantage of itemization, because there's only so many things that you can deduct through itemization. So that's the big one, is they increased the standard deduction. The second one, adjustment, comes to tax brackets. So if you are in a high tax bracket or you have a lot of earned income, this one may affect you, which is for those in the 37% tax bracket. It now starts for those making over $731,200 for joint filers and $609,530 for single filers. So they kind of bumped up that 37% tax bracket. So if you had a really nice year, sorry, you're going to be taxed higher.
Okay, we've covered a lot of topics during this episode. So lastly, can you just give us a few topics to follow as we go into December and maybe even into the new year as far as the market's concerned?
Surely. So I think what surprised us in 2023 so far is how much better growth did than value and how much better large and mega cap did compared to small cap. I personally think that there's opportunity in those areas of value and small cap that underperformed in 2023 going into 2024, as we talked about a little bit earlier in the podcast. I also am curious to see how consumers behave, how household debt is as we wrap up the year, and spending habits of consumers during the holidays. So that'll be something to watch. As inflation cools, corporate profits, do they continue to maintain a steady pace? Where when inflation was at its peak, we saw like certain types of companies that are more susceptible to pricing really be hurt by inflation. So think of like Walmart and Dollar General, where their profit margins are thin. They don't have a big markup on the goods that they're selling, so they were really impacted by inflation. And as inflation starts to cool, well, those types of companies start to really shine.
All right, as always, if you'd like to find out more information, get some more insights on the market and investment strategies, you can visit basewealthmanagement.com. You can subscribe to our YouTube channel or simply follow us on this podcast so that you get the updates right to your phone.
Also, don't forget to submit your questions. Should you have any questions or topics you want to see us discuss on the podcast, you can submit those to question@basewealthmanagement.com.
All right, I'm Dustin Taylor.
I'm Alex Wolfe.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolfe, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.